Welcome to Thoughts on the Market. I'm Michael Zezas, Morgan Stanley's Global Head of Fixed Income Research and Public Policy Strategy. Today, we'll be talking about the market impacts of the recently announced tariff increases. It's Friday, April 4th at 1 p.m. in New York. This week, as planned, President Trump unveiled tariff increases. These reciprocal tariffs were hiked with the stated goal of reducing the U.S.'s goods trade deficit with other countries. We've long anticipated that higher tariffs on a broad range of imports would be a fixture of U.S. policy in the second Trump term, and that whatever you thought of the goals tariffs were driving towards, their enactment would come at an economic cost along the way. That cost is what helped drive our team's preference for fixed income over more economically sensitive equities. But this week's announcement underscored that we actually underestimated the speed and severity of implementation. Following this week's reciprocal tariff announcement, tariffs on imports from China are approaching 60%, a level we didn't anticipate would be reached until 2026. And while we expected a number of product-specific tariffs would be levied, we didn't anticipate the broad-based import tariffs announced this week. All totaled, the U.S. effective tariff rate is now around 22%, having started the year at 3%. So what's next? Our colleagues across Morgan Stanley Research have detailed their expected impacts across equity sectors and asset classes, and here are some key takeaways to keep in mind. First, we do think there's a possibility that negotiation will lower some of these tariffs, particularly for traditional U.S. allies like Japan and Europe, giving some relief to markets and the economic outlook. However, successful negotiation may not arrive quickly, as it's not yet clear what the U.S. would deem sufficient concessions from its trading partners. Lower tariff levels and higher asset purchases might be part of the mix, but we're still in discovery mode on this. And even if tariff reductions succeed, it's still likely that tariff levels would be meaningfully higher than previously anticipated. So for investors, we think that means there's more room to go for markets to price in a weaker U.S. growth outlook. In U.S. equities, for example, our strategists argue that first-order impacts of higher tariffs may be mostly priced in at this point, but second-order effects, such as knock-on effects of further hits to consumer and corporate confidence, could push the S&P 500 below the 5,000 level. In credit markets, weakness has been and may continue to be more acute in key sectors where tariff costs are substantial and may not be able to be passed on in price, such as the consumer retail sector. These are companies whose costs are being driven by overseas imports. So what happens from here? Are there positive catalysts to watch for? It's going to depend on market valuations. If we get to a point where a recession is more clearly in the price, then U.S. policy catalysts might help the stock market. That could include negotiations that result in smaller tariff increases than those just announced, or a fiscal policy response, such as bigger than anticipated tax cuts. Thanks for listening. If you enjoy the show, please leave us a review wherever you listen, and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.